Gold prices are soaring, and investors are scrambling. What do they know that you don't? With every headline predicting doom and market instability, the smartest money is moving fast. And they're all looking in one direction: gold. Why is everyone suddenly so afraid of a market crash? And what does it mean for your investments? The answers could change everything you think you know about the financial world. Stay with us as we reveal the surprising strategies being used by those in the know, and discover how you can protect yourself before it's too late. Enjoyed this content? Then don't miss out on the other videos on my channel. I'm sure you'll find something that catches your interest. And if you haven't subscribed yet, make sure to hit that subscribe button and turn on notifications. That way, you'll stay updated with all the new content and help the channel grow even more. I'm counting on you. Protection against volatility. When the stock market becomes volatile, gold emerges as a safe haven for many investors. They look for safety in an asset that is not as susceptible to sudden fluctuations as stocks or bonds. During financial crises, the value of gold tends to increase or, at the very least, remain stable, offering a hedge against significant losses. This characteristic makes gold especially attractive when the stock market is under threat, as investors seek to preserve their capital in the face of uncertainty. This quest for security reflects a desire for stability in chaotic times. When panic grips the markets, gold represents an anchor, an asset that weathers the storm. Stock market volatility can devastate investment portfolios, but gold, with its reputation for stability, attracts investors who want to avoid the emotional and financial roller coaster. This protection is crucial for anyone looking for a long-term strategy to protect their wealth against unexpected crises. Hedging against inflation. As inflation threatens to erode purchasing power, investors turn to gold as a reliable hedge. Gold has a long history of preserving value during periods of high inflation, functioning as a store of value when currencies lose purchasing power. In times of rising inflation, gold becomes more than just an investment. It is seen as a safeguard against the erosion of wealth, providing a means of maintaining value in times of economic uncertainty. Investing in gold during inflation is not just a matter of preserving capital. It is a strategy to protect the financial future. With monetary policies often increasing the money supply to combat crises, the risk of inflation grows, and gold emerges as a safe haven. Its ability to resist the depreciation of money makes it a crucial asset for those looking to protect their savings against the loss of purchasing power in an inflationary scenario. Portfolio diversification. Diversification is an essential strategy for managing risk, and gold plays a key role in this balance. In a well-diversified portfolio, gold acts as a counterweight, helping to smooth out losses when other assets, such as stocks and bonds, face declines. This is especially valuable during economic downturns, when gold's negative correlation with the stock market can help protect investments and mitigate the impact of a market crash. Having gold in your portfolio is more than a financial decision. It is a survival strategy. In times of extreme uncertainty, diversification with gold provides a hedge against volatility and risk. It works like financial insurance, providing investors with peace of mind that a portion of their wealth is protected from economic disasters. This approach reduces the risk of total loss and ensures that the portfolio has a defense against adverse events. Emotional and behavioral reactions. Investors' behavior is often driven by fear and uncertainty, especially in times of crisis. Investor psychology plays a crucial role in the decision to buy gold. When the fear of a stock market crash increases, the emotional response is to seek safety in hard assets like gold. This move is driven by a knee-jerk reaction to risk, where gold's perceived safety trumps the logic of holding other volatile assets. These emotional reactions create a domino effect in markets, where collective fear fuels a gold rush, exacerbating the perception of crisis. Investors, driven by the fear of losing their savings, often act irrationally, following the behavior of others in a herd effect. This cycle of fear and action creates an environment where gold is not just an investment. It is a symbol of insurance against the perceived collapse of the financial system, intensifying its appeal in times of uncertainty. As the market teeters on the edge, the rush to gold might just be the beginning. What will you do when the next wave of uncertainty hits? Why are seasoned investors still doubling down on gold, even as others remain complacent? And how can you position yourself to not just survive, but thrive in the face of the unknown? The game is changing, and the next big move is right around the corner. Are you ready to seize the opportunity, or will you be left wondering what happened as the tides turn? The answers are closer than you think. Stay alert, stay informed, and stay prepared.